if you qualify for a USDA or VA loan, you may be able to skip the down payment altogether and buy your home with no money down except for a small funding fee. Let's talk about the top 4 factors to consider when choosing your mortgage. With home prices and rates still relatively high, securing the mortgage can feel daunting, even to the most experienced borrowers. But don't let that deter you. If other home buyers experience any indication, odds are you'll eventually find a home loan that works well for you. In fact, most US homeowners say they are satisfied with the mortgage they receive. According to a recent Bankrate survey, the vast majority of the survey homeowners, about 69%, said they'll buy their current home again if they have the do-over. My name is Daryl Hahn, your go-to real estate advisor in the East Bay Area. My goal is to bring you valuable information on real estate related topics in the Bay Area and to keep you up to date and help you make an informed decision with your real estate needs. If you like the content, please smash the like button and click subscribe for more future content. The key to finding the right home loan for you is to look for the one that will make you feel comfortable long after you close on your new property. In addition to comparing terms, length, and mortgage rates, also consider how the loan will fit your daily life and preferences. For example, we recommend asking yourself questions such as, are you a natural risk taker? Or do you prefer firm plans or predictabilities? Can you afford bigger mortgage payments if interest rate increase? Or your anticipated home expenses already stretching your monthly budget? To help you get started, we have rounded up 4 of the most important factors to consider when you narrowing your list of potential mortgage options. First factor, your credit score. That 3-digit number that credit scoring companies like VantageScore and FICO assign not only influences your interest rate, but it also helps determine the type of mortgage you'll get. To secure a conventional mortgage from a major bank or credit union, you will typically need a FICO score of at least 620, but some mortgage types require even higher credit score. For example, to qualify for a U.S. Department of Agriculture or USDA loan to buy a qualified rural property, you'll need a minimum FICO score of 640. Or if you're seeking a supersized loan, such as a jumbo mortgage, which are home loans over $766,500 to $1.149 million depending on where you buy the home. You may need a FICO score of at least 700 or more. You still have your options though. If your credit score is lower, you may be able to get a Federal Housing Administration or FHA loan with a 580 credit score if you have enough cash saved or at least 3.5% down payment. And if you have at least 10% down payment, you may qualify even if your credit score is in the 500 or 579 range. Alternatively, if you're a military service member, veterans, or spouse, you may be able to get a U.S. Department of Veterans Affairs or VA loan with little or no money down with a credit score in the 580 to 620 range. Some regional banks and credit unions may also be more flexible than others with minimum required credit score. But if you can afford to wait, you may be better off paying down your debt first so your credit scores can improve. The interest you save with a more competitive pricing loan could enable you to buy a more desirable home. Second factor, your income and expenses. The amount of money you make as well as how much you owe will also influence your mortgage option. Lenders like to see that you still have plenty of income left over after paying your expenses and generally prefer that you spend no more than 28% of your income on housing or a maximum of 36%, which is the cap that federally sponsored lenders Fannie Mae and Freddie Mac advice. A mortgage lender will also compare your expected income to the total amount of debt you'll carry once you bought the home. This is called your debt to income or DTI ratio, and lenders consider it a key indicator of whether you can afford a particular mortgage. In fact, research by NerdWallet found that the high DTI ratio is the most common reason mortgage applications get rejected. In addition to outstanding debts, Lenders factor in other expenses unique to a home, such as property taxes, home insurance, or homeowner association fees. Your approval odds will be higher if you have a DTI ratio below 36%. But if you have a great credit or ample cash, you may still be able to get a conventional loan with a DTI ratio in the 45 or to 50 ranges. If not, you will likely need to look to other non-conforming loan types, such as government-backed mortgages. With an FHA loan, for example, you may be able to get away with a DTI ratio of 43% to 57%, depending on your credit score and savings. Similarly, if you qualify for a VA loan, you may be able to get one with a DTI ratio of 41% or more. USDA loans, on the other hand, are a bit stricter. To get approved, your DTI ratio can be higher than 41%, and your income must be below a certain threshold for your family type. Thinking about relocating to the Bay Area? Well, I got just the thing for you. I'm actually taking the time to create the ultimate relocation guide, which is meant to save you hours of research, and I have linked it down below. From top employers to the best hospitals, the top rated schools, and a boatload of other things that you need to know before you make the move. The best part of this guide is 100% free. That's right, you heard it. It's 100% free. Hope that helps. Third factor, your expected down payment. The size of your down payment will also impact the type of mortgage you can get. You don't have to put down 20% to qualify for conventional mortgages, but you will need a significant amount. According to the National Association of Realtors, the median down payment amount in 2023 was 14%. For younger buyers under the age of 33, it was 8%. In some cases, a larger down payment may also help you qualify for loans you might not otherwise. For example, it can be tough to get a mortgage when you're self-employed, but some conventional lenders may be willing to work with you if you put down more than 20%. If your cash reserves are slim, then you may want to consider an FHA loan, which will only require 3.5% down. Or if you qualify for a USDA or VA loan, you may be able to skip the down payment altogether and buy your home with no money down except for a small funding fee. Keep in mind that a small down payment will likely mean a larger monthly payment. Plus, you not only pay more interest overall and be responsible for a larger principal, you will also need to take out mortgage insurance. Conventional loans require private mortgage insurance or PMI if your down payment is less than 20%, while FHA loans are always require insurance. How much you spend on mortgage insurance will also vary, depending on the size and types of loan you choose, as well as your credit score and other factors. For example, FHA mortgage insurance premium MIPs are generally more expensive than PMI and also require an upfront payment at closing on top of an annual premium. Insurance for adjustable rate mortgage or ARMs also tend to be on the higher side. The fourth factor, your lifestyle and risk tolerance. In addition to your budget, one of the most important factors to consider when comparing mortgage options is your temperament. For most Americans, a mortgage is a decade-long commitment, so it's important to find one that you can be happy to live with and comfortably repay for the long haul. Most fixed mortgage rates, for example, are designed to last anywhere from 15 years to 3 decades or more, with 30-year mortgage being the most popular options. When you spread out your repayment over such a long period of time, monthly payment amounts are smaller, so you can slowly chip away at your debt at a leisurely pace. The catch is, you'll also pay more in interest. With a shorter mortgage term by contrast, you pay less overall, but your monthly payment amount will also be much higher. For example, for some homeowners, the long-term savings are worth it, but if keeping up with your mortgage requires a significant lifestyle adjustment, then you may come to regret it. Another way to lower your monthly payment in the short term is to choose an adjustable rate mortgage or an ARM that offers a low fixed APR for a lengthy period. typically 5, 7, or 10 years before changing a variable rate. This can be an especially useful loan if you only plan to stay in the home for a relatively short period. But be aware, ARMs can be risky if you don't plan ahead for a higher interest rate. Well, this is it. If you like the content, don't forget to smash the like button and click the subscribe for more future content. I look forward to seeing you on to the next video.